All right, let's dive into one of the trickiest, most high-stakes areas of any audit, inventory costing. This is a place where even seasoned pros can get tripped up and where one little mistake can throw off the entire financial statement. So we've put together a practical, risk-based guide to help you audit it with total confidence. Let's get right into it.
So why do we call this an audit minefield? Well, if you've ever audited a manufacturing company, you probably know that feeling. You're looking at the numbers, but you can just feel that there's something incredibly complex and important happening right under the surface. And that's exactly where the real risk is hiding.
The stakes here are just huge. A simple error in costing, that immediately messes up your cost of goods sold. A mistake in how they apply overhead, suddenly your gross margin analysis is completely unreliable. And those variances that pop up, they're not just numbers on a page. They can be big, flashing red lights for a major misstatement or even fraud. Whether it's outdated standard costs or a messy actual cost system, the potential for error is literally everywhere.
So here's our game plan. First, we're going to define what we call the danger zone. Then we'll break down the two main methods you'll see, standard versus actual costing. After that, we'll give you a specific audit playbook for each one. And we'll wrap it all up by covering the critical red flags that you just can't afford to miss.
Let's be really clear about this. The costing area isn't just a part of the inventory audit. It is the absolute heart of it. If you get this right, you've got a solid foundation for your inventory value and your COGS. But if you get it wrong, well, everything else you do is built on quicksand. Okay, so when you walk into a manufacturing client, you're pretty much always going to find one of two systems running the show. Your very first step as an auditor is to figure out which one they're using, because that single fact is going to dictate your entire audit approach. So let's break them down.
This slide really gets to the core of it. On the left, you've got standard costing. That's all about predetermined estimates. The company sets a standard for what a product should cost. Your job as the auditor is to focus on the variance, the difference between that standard and what actually happened. Then on the right, you have actual costing, which is all about capturing reality as it happens. It tracks the real costs using methods like moving average or FIFO, which is just first in, first out.
So, what exactly makes up a standard cost? It's not just some number they pull out of thin air. Think of it like a recipe. You've got the bill of materials, the BOM, which lists all the ingredients. You have the routing, which is like the recipe instructions for machine and labor time. And then you have your standard rates for what you pay for that labor and overhead. You put them all together, and boom, you get the standard cost for one product.
And you might be asking, why do so many companies use this method? Well, honestly, it makes their lives a lot easier in a few key ways. It simplifies their budgeting, gives them a really clear benchmark for controlling how efficient their production is, and it makes analyzing variances super straightforward. Plus, let's be real, most of the big ERP systems come with this feature baked right in.
Now let's flip the coin and talk about actual costing. Just like the name says, this system is all about what really happened. It's built on the actual price the company paid for materials, the actual labor costs they incurred, and the actual overhead they allocated to production during that time. No estimates here.
Okay, enough theory, let's get practical. If you find out your client is using standard costing, this is your step-by-step playbook. These are the core audit procedures you absolutely have to perform.
Here it is, your 6-step plan. First, you've got to understand how they build up that cost. Then, you test the two most critical ingredients, the bill of materials and the routing. After that, you're going to recalculate the cost yourself to make sure it adds up. Then you dive deep into analyzing the variances, and finally, you check exactly how those variances are being treated in the financial statements. Now let's zoom in on what is probably the most important step of all, testing that BOM. Testing the bill of materials is absolutely non-negotiable. You need to grab a sample of products and literally trace the materials and quantities back to what's listed in the system's BOM. Are the quantities realistic? Are the part numbers and costs correct? And here's a classic trap. Are there obsolete materials just sitting in the BOM artificially inflating the cost? This is where your audit work gets very real very fast.
So, what happens if your client uses actual costing instead? Well, the whole focus of your audit shifts, and it shifts dramatically. It becomes less about testing estimates and way more about testing the accuracy of how they capture data in real time.
So here's the playbook for an actual cost system. Your number one focus is testing the actual purchase costs. Then you'll need to recalculate their cost flow assumption, whether it's moving average or FIFO. Just like with standard costing, you've got to test their overhead allocation. And crucially, you need to check how costs are being collected and work in process. That's all the stuff that's only partially built out on the factory floor. The single most important procedure here is what we call the three-way match. You have to trace the paper trail, or the digital trail, from the purchase order, the PO, to the supplier's invoice, to the goods received note, or GRN. Then you verify that the right amount actually hit the system. This one test is the cornerstone of validating the inputs into an actual cost system. All right, we've walked through both playbooks. Now let's talk about what happens when things start to look a little off. These are the red flags that should make any auditor pause and dig a whole lot deeper. So picture this. You're sitting in a meeting with the plant controller, and they casually drop this line. This is, without a doubt, one of the most common and dangerous red flags you can find in a standard costing environment.
So why is that so dangerous? Because an outdated standard cost means the company is comparing today's real costs to a benchmark that's totally irrelevant. It makes our gross margin useless and creates these massive, meaningless variances. The whole point of the costing system just goes out the window.
Okay, here's another one. You're looking through the variance reports, and you see these huge swings from month to month or year over year. And when you ask management about it, their explanation is fuzzy, or they don't have one at all.
This is exactly why it's so risky. Large, unexplained variances are just the symptom. The disease underneath could be major production problems, significant costing errors, or, worst-case scenario, a deliberate attempt to manage earnings by playing games with how variances get recorded.
So let's pull all of this together in a nice summary table. Think of this as your cheat sheet for any manufacturing audit. In a standard cost world, your core test is the BOM and routing accuracy, and your key risk is all about variance analysis. In an actual cost world, your core test is that purchase price tie-out, and your key risk is making sure WIP costs are accumulated correctly. If you keep these differences straight, you'll know exactly where to put your energy. And that brings us to our final thought. After all the testing is done, after all the procedures, this is the one question you have to be able to answer. It's not just about checking boxes on a work program. It's about taking a step back and asking yourself, based on everything I've done, can I confidently sign off on the reliability of this company's inventory and cost of goods sold? Getting the costing right is how you answer that question with a definite yes.